What if you could transform your routine spending into significant tax write-offs? In 2026, business owners will discover how to do exactly that, legally reducing their tax burden by deducting expenses they already incur daily. You will need to follow these rules precisely as they are shared. Today, we will break down how to leverage the tax code to its fullest extent. One of the most important concepts in tax strategy is that not all income is taxed the same way, nor is everyone permitted to deduct the same expenses. As a general rule, business owners have access to far more tax deductions than W-2 employees. If you earn income as an employee, your taxes are largely handled for you, intentionally, by the government. Federal income tax, state income tax, Social Security tax, and Medicare tax are all withheld before your paycheck ever reaches your bank account. Over the last several years, especially following tax law changes in the late 2010s and early 2020s, most unreimbursed employee expenses have been eliminated or severely restricted. By 2026, the vast majority of W-2 employees will have very limited ability to deduct everyday work-related costs. Have you noticed these changes? Perhaps you used to take your team out for lunch or dinner and get it reimbursed. Many of these changes now prevent you from doing so. Business owners, however, operate under a completely different system. The fundamental difference lies in risk and responsibility. The IRS recognizes that business owners assume far more financial risk than employees. For instance, entrepreneurs must invest their own money to start a business, sign lease agreements, purchase equipment, cover payroll costs, and manage cash flow. They also make hiring and firing decisions, navigate state bylaws, and operate without guaranteed income. When revenue drops or expenses spike, the business owner absorbs those losses, not the employee. Because the economy depends on entrepreneurship, innovation, and job creation, the tax code is intentionally structured to encourage people to start and grow businesses. These incentives manifest as expanded deductions, accelerated write-offs, depreciation rules, and favorable tax treatment of certain business expenses. These are not loopholes or gray areas. They are deliberate policy choices written into the tax code by a government that created intentional incentives. This brings us to Internal Revenue Code Section 162A, your essential tool for business deductions in 2026. This section outlines how business owners can deduct expenses, stating that they can deduct expenses that are ordinary, necessary, and reasonable in the pursuit of business income. An expense is considered ordinary if it is common and accepted in your industry. It doesn't need to be something every business owner spends money on, but it should make sense given the nature of your business. An expense is necessary if it is helpful and appropriate for running your business. The IRS does not require an expense to be absolutely essential. It simply needs to contribute to income generation or business operations to qualify under Code Section 162A. Finally, an expense is reasonable if its cost is not excessive relative to its purpose. Spending money to improve efficiency, reach customers, or operate your business is generally reasonable. However, spending far outside industry norms without justification may raise questions, though it doesn't automatically trigger an audit or disallow the expense. If an expense meets these criteria and is properly documented, it may be deductible. This framework is precisely what allows everyday expenses to become legitimate write-offs when used correctly. Let's explore some of the most common and powerful deductions available to business owners in 2026, which W-2 employees generally cannot access unless they start a business. First, home-related expenses. Every taxpayer spends money to live under a roof, but if you're a business owner, you may qualify for the home office deduction. If you work from home, and use part of your home exclusively and regularly for business, this deduction remains one of the most powerful and frequently misunderstood tools available only to business owners. Your home office doesn't need to be a traditional office with a desk and filing cabinet. It could be a converted bedroom, your garage, an extra space, or a dedicated section of your basement or attic, as long as it's clearly defined and used solely for business. The two key requirements, which often arise in IRS audits, are exclusive and regular use. If the space is used for personal purposes, it generally doesn't qualify. However, if it's dedicated to business and used consistently, it might be eligible. Because your office is within your home, you can deduct a portion of your everyday home expenses. This includes a percentage of your rent, or for homeowners, a portion of your mortgage interest and property depreciation. Utilities like electricity, internet, and cell phone or home phone services are also eligible, along with homeowners or renters insurance. Surprisingly, if you make repairs and improvements to your home, a percentage of those costs can also be included in your deduction. There are two ways to calculate the home office deduction. The simplified method remains unchanged in 2026. You can deduct $5 per square foot for a maximum of 300 square feet, approximately 87 square meters, resulting in a maximum deduction of $1,500. This method is straightforward and requires minimal record keeping. The actual expense method is preferred by most business owners seeking to maximize their write-offs. With this approach, you calculate the percentage of your home used for business and apply that percentage to your actual home expenses. For example, if your office space is 250 square feet, about 23 square meters, and your entire home is 2,500 square feet, about 26 square meters, your office represents 10% of the total area. This means you could deduct 10% of eligible home office expenses. If your total home office expenses for the year were $40,000, you would get a $4,000 deduction. Over time, this deduction can compound significantly as long as you remain a business owner, helping many save substantial money on taxes. Beyond home expenses, business owners also have other deductions, such as laptops and equipment. Most business owners need a laptop for various business purposes, including sending emails, creating documents, setting up advertising campaigns, graphic design, PowerPoint presentations, or bookkeeping. The IRS allows you to write off a laptop as a legitimate business expense, as it is considered ordinary, necessary, and reasonable for nearly every business owner. If you don't use your laptop 100% for business, you can still write off the percentage of its use that is business-related. However, most business owners purchase the laptop under their business name, and the IRS understands that occasional personal use is common. Therefore, if purchased under your business, you can generally deduct the laptop in full. Cell phone expenses follow similar rules. If you use your phone for business calls, client communication, scheduling, navigation, text messages, email, or content creation, a portion, or even the entirety of your phone expenses may be deductible. The IRS recognizes that most business owners operate off a cell phone 5 days a week, often taking calls on weekends, while also fielding some personal calls. Deducting your business line and cell phone under Code Section 162A is permissible. This also includes monthly service plans, data, and hotspot usage. For example, if you purchase a $1,200 phone and determine that 65% of its use is business-related, you can deduct $780. Many business owners now use multiple phones, one dedicated to clients and another for family. As long as the business use is legitimate, documented and reasonable, these expenses may be deductible. Next, vehicle expenses. Many business owners have a vehicle purchased in their personal name, which can be a valuable deduction. The IRS scrutinizes vehicle deductions less if you meticulously track your business use. Business use is key to determining eligibility. Traveling to client meetings, visiting job sites or properties, attending networking events, grabbing coffee for business purposes, or running business-related errands all qualify as business use. You should track the time you operate your vehicle for business. There are two primary ways to calculate this deduction. The first is the standard mileage method, ideal for those who drive frequently for business, perhaps 50% of the week or more. With this method, you track business miles driven and multiply them by the IRS-approved standard mileage rate. In 2026, this rate is 72.5 cents per kilometer, adjusted annually due to inflation. Only business miles qualify. Commuting miles do not. For instance, if you drove 20,000 business kilometers in 2026, multiplying that by $0, 725 yields a $14,500 deduction. Imagine the benefit of a $14,500 deduction, freeing up thousands of dollars for reinvestment, family vacations, or debt repayment. This method is simple. You just need to maintain a mileage log detailing the date, purpose, and kilometers driven for each business activity, which substantiates your deduction in case of an IRS inquiry. The second option is the actual expense method. Here, you total all vehicle-related expenses, including fuel, maintenance, repairs, insurance, and even DMV registration fees. Crucially, this also includes vehicle depreciation. You then multiply this total by the percentage of your vehicle's business use. For example, if you have $14,000 in total vehicle expenses and use your vehicle 60% of the time for business, you would multiply $14,000 by 60%, resulting in an $8,400 deduction. In certain cases, business owners may also use Code Section 179 and bonus depreciation to deduct a larger portion, or even all, of a vehicle's purchase price in the first year. Business meals remain deductible in 2026, though the rules have become stricter. In most cases, business owners may deduct 50% of qualifying business meals. To qualify, meals must have a clear business purpose, such as meeting with a client, prospect, referral partner, or business associate where business is actively discussed. The IRS requires detailed documentation, including the date, location, attendees, what was discussed, and the amount spent, including tips. The business purpose should be noted, perhaps on the back of the receipt, along with the names and roles of all attendees. Meals are a common audit area, so thorough documentation is critical. Business travel expenses are deductible when travel is required for a legitimate business purpose and takes you away from your tax home, which is generally the area where your primary business generates income. In other words, you must be traveling far enough that rest or sleep is required, and the trip must be directly connected to conducting business activities under Code Section 162A. Deductible travel expenses can include airfare, train tickets, buses, car rentals, ride shares, hotels, lodging, and other accommodations. This also extends to baggage fees, tips, internet access while traveling, and laundry or dry cleaning. Local transportation expenses incurred while traveling, such as taxis or public transport, are also deductible. To qualify, the trip must be primarily business-related. This means the main reason for the trip must be business, not a personal vacation. A personal vacation does not become deductible simply because you answered emails, took phone calls, or scheduled a single meeting. If your goal is to incorporate personal activities into business trips, understand that the primary purpose must be business with incidental personal activities. Strong documentation is critical. Keep receipts, itineraries, Google Calendar entries, meeting agendas, and written notes describing the business purpose of each trip. The more clearly you demonstrate business intent, the stronger your deduction becomes. Education, coaching, and professional services are often overlooked. Business owners can deduct these expenses because they help maintain and improve skills related to their existing business, making them ordinary and necessary. These deductions are designed to help you stay competitive, increase expertise, and grow your business while remaining IRS compliant. You can deduct the cost of courses, workshops, industry-specific conferences, seminars for learning new skills, or hiring a coach or consultant to improve your business. This includes accounting, legal, and tax advisory services. The key limitation is that the expense must relate to your current times business. Education or training that prepares you for an entirely new profession or unrelated career path may not be deductible under your current business, though it might qualify as a startup cost if you've already established a new business. These deductions are powerful because they allow you to invest in your business's growth and professional development while simultaneously reducing your taxable income. They are essential for business owners to grow revenue and lower tax liability. Proper documentation, including receipts, invoices, and course materials, ensures these deductions are fully supported in case of an IRS audit. Finally, subscriptions. In 2026, nearly every business owner relies on digital tools for day-to-day operations, and many of these are 100% deductible as ordinary business expenses. These are tools you probably use daily without thinking about it, such as productivity apps, Microsoft 365, Google Workspace, Notion, bookkeeping software, QuickBooks, FreshBooks, AI tools, Claude, OpenAI, or project management tools Trello, Monday.com. Cloud storage subscriptions like Dropbox or Google Drive, communication platforms like Slack or Zoom, and creative platforms like Canva or Photoshop are also deductible. You just need your receipts, proper documentation, and the pursuit of income. If you pay for these tools regularly, monthly or annually, you can deduct the full cost for the portion used in your business. For instance, if you pay $50 per month for an app used 80% of the time for business, you can deduct $40 per month. The key is to track what you use and how each subscription contributes to your business. An Excel document listing all apps, subscriptions, and their business purpose can make your deductions clean and audit-proof. These recurring costs, when recognized on your tax returns, can be written off every year, reducing your taxable income. This allows you to continue investing in tools that streamline your life, knowing you're documenting and deducting these expenses, making your life smoother and reducing your tax burden. As more work becomes digital, understanding this deduction is essential for capturing meaningful tax savings annually. When used correctly, the tax code in 2026 strongly favors business owners who understand how to apply strategy properly. We advocate for W-2 taxpayers to become business owners through rental real estate. You don't need to quit your job. Simply investing in real estate is viewed as a business and an investment by the IRS. The moment you add a business to your tax return, everyday expenses, ordinary, necessary, and reasonable become deductible for you. The goal is not to be aggressive or reckless, but to be intentional, informed, and compliant. The tax code already rewards entrepreneurship. You simply need to know how to use it correctly. If you do, you can dramatically reduce your tax bill while simultaneously building a stronger, more efficient business. If you're seeking advanced tax strategies and earn over $300,000 annually, consider scheduling a consultation with a property legal tax strategy team by clicking the link in the description below. Thank you for watching and for subscribing to Property Legal. We'll see you in the next video. Cheers.